This week on WealthTrack, how great investor Dennis Stattman is navigating the great divide between the slow-growing developed world and the fast-growing developing one. Paper-based assets and hard real assets, bonds and stocks. BlackRock Global Allocation Fund's Dennis Stattman on managing a bifurcated investment world is next on Consuelo Mac WealthTrack.
The company you keep is also the company we keep. Together, we help provide a lifetime of guaranteed income and investment solutions.
Additional funding provided by Loomis Sales, investors seeking exceptional opportunities globally, research affiliates, an efficient index for an inefficient market, Wintergreen, your home for global value, and Rosalind P. Walter.
Hello and welcome to this edition of WealthTrack. I'm Consuelo Mac. We have said many times in the past that in this global and interconnected world we live in, money will flow to where the growth is and will leave where growth is lagging. The developed world, Europe, the US, and Japan, are all in the lagging column right now. According to independent research firm ISI Group, over the past 8 years, China's nominal GDP, that's with inflation included, has accelerated 250%. In contrast, U.S. GDP has expanded only 40%. The Eurozone's a mere 25%, and Japan's nominal GDP has actually contracted 5%. And recent figures show China's economy is still booming, as are many other developing nations, whereas the mature economies of the West and Japan, with their heavy levels of government debt, unemployment, aging populations, and slow recoveries from a series of real estate, banking, and credit bubbles, are laboring. According to many economists, the debt reduction or deleveraging process, as it is known in the trade, will be particularly painful and lengthy, taking several more years. As a recent article in The Economist put it, get used to it. Well, what's an investor to do? And that's where this week's great investor guest comes in. We last talked to Dennis Stattman, lead portfolio manager of BlackRock's Global Allocation Fund, at the beginning of this year. Given the rapid escalation of world events, we decided we better get an update. Stattman, who once worked at the World Bank, had the prescience to join the now $55 billion plus fund at its inception way back in 1989. Since then, the fund has had only 3 down years and has outperformed most stock and bond markets, as well as the majority of its peers, with less than stock market volatility, achieving a primary goal. It's done it with a broadly diversified portfolio of 700 plus individual stocks, bonds, alternative investments, and cash invested around the world. I began my visit with Stattman by asking him why he thinks there is something artificial about the current market environment.
Treasury bond prices have been heavily influenced by the purchases the Federal Reserve has been making, and they've been quite explicit about this. They want Treasury bond prices higher and yields lower than they otherwise would be. And in the end, all fixed income prices and yields are influenced by the Treasury market. And so when the Treasury market is artificially high in terms of price and low in terms of yield, that tends to influence all fixed income security prices. And in fact, since fixed income securities compete with other assets, that tends to influence all asset prices. And we believe that asset prices have been held higher than they otherwise would have been because of the Fed's purchases.
So therefore, the rally that we've seen in what we now call risk assets, that Ben Bernanke has said was one of the reasons that he did the QE1 and QE2. So in fact, you're saying the risk assets are artificially inflated.
They could well be. Now, to different degrees, and we happen to think that the Treasury bond market is the most inflated, and the stock market has a more questionable amount of inflation in its prices.
So what happens now that the Fed at least will not be actively buying Treasury securities, at least the new issues? They're going to be turning over their portfolio, right? in replacing as the treasuries that they hold on their balance sheet mature, they're going to continue to buy to replace those with treasuries. Is that correct? So we've still got some stimulus going on even though the QE2 officially ended?
They're maintaining, we believe, the size of their portfolio, but they've told us they're not going to be increasing the size of it. So our sense is that having been through a program where they were buying approximately 1/10 of $1 trillion worth of securities per month, that when you take away the growth in demand that they've been providing, that the Treasury market's going to have to find another buyer. And if it's not a foreign buyer, then it's going to need to be a domestic buyer. And we have not, for some time now in this country, been self-financing. And it might take higher interest rates to do that.
And when do we start to see that pressure building?
Well, I certainly hope rates are going to go higher, not just in order to reward savers, but if rates don't go higher, that would probably be associated with a very weak economy and perhaps even financial trouble again someplace in the world, for example, in Europe. So our hope is that higher rates would be accompanied by at least a decent economy, and I think if we have a decent economy, we will have higher interest rates.
Okay, so let's talk about a decent economy. Are we going to have a decent economy, and if so, when?
We'd love to see something far more dynamic than we're seeing, but so far we haven't seen employment strengthen enough to, for example, reduce the average length of unemployment, which is distressingly high. So what we think we will continue to see is a world in which the developing economies outgrow the developed economies and where the developed economies struggle to get back to trend growth.
But the theme is that you felt that we've had a bifurcated world, essentially, that
Yes.
they're not the haves and the have-nots, but they're the rise of the rest.
Mm-hmm.
Where are you seeing the rise of the rest that's most noticeable, and that really is, and what are the areas that you think that we should be paying particular attention to as investors?
Well, clearly, China, India, Brazil, and those are very well-known stories, but they're powerful stories, and these are not stories that are going to change every 3 or 6 months. These are decade or multi-decade long stories. It's simply a case that production, jobs, income, and wealth are spreading much more broadly around the world. And in fact, what's generating those jobs and income and wealth growth is increasingly domestic consumption in some of those countries, especially China.
How risky is the China story, and the fact that so many of us seem to be banking on China as kind of the driver of world growth in the 21st century? And what are the risks to that scenario?
Surely when loan growth is as robust as it has been in China, and where lending policies are influenced by many different levels of government, you're going to have some very questionable sorts of loans created. But at the same time, the growth of the bank's assets to some degree means that the portion of them that are troubled from a year or 2 years ago is not as overwhelming as it otherwise would be. We should also keep in mind that China is a country of financial surpluses, and surpluses on the one hand are associated sometimes with growth that is so fast that there are problems created, but at the same time surpluses are surpluses and they can absorb losses.
What are the surpluses that you're talking about that you think can provide a cushion to China, even in the case of some sort of a downturn or at least a slowdown?
Well, let's keep in mind that China generates a high level of savings, a high level of trade surplus. It has the world's highest foreign exchange reserves by far, and it's in a position to use some of those reserves and that power to generate financial assets to repair when there's some problems. And also, if a growth rate of 10 or 11% turns into a growth rate of 7 or 8%, it's still a growth rate.
Let's talk about another controversial statement that you made, and that is that government bonds are not safe. whose government bonds are not safe and why are they not safe?
Well, we believe that most government bonds are safe in terms of the nominal value of them. In other words, that most of them will pay their interest and pay their coupons on time. Might not be every single one of them, and we can think of some countries in Europe that are very questionable at this point.
Greece and Spain and Portugal and Ireland are...
I would say at least Greece and Portugal are in serious question. And
right.
Of course, they're small enough to be manageable. The big question is probably Spain, and if Spain were to get into trouble, people would look around for the next country to worry about. And let's hope that the trouble stops before it gets to Spain not being able to meet its obligations. But I think more to the point is simply something like U.S. Treasury bonds. A 10-year Treasury yields a little over 3% these days. And what that really means is that's like a stock that sells at a PE ratio in the 30s but has no growth. And this is before inflation and before taxes. And we are right now as a nation facing a big deficit that has a large cyclical component, and that cyclical component is also occurring at the same time. There is a tidal wave of demographic related spending that is just starting to happen and will grow and grow and grow.
The
for
baby
the rest.
boomers, Social Security, Medicare. Mm-hmm.
Exactly. That will grow for the rest of our lifetimes. And we don't, as a nation, yet have much of a plan about how to pay for it. And given that we're starting with very low interest rates, a low but rising rate of inflation, very low real interest rates, the real interest rates on a Treasury inflation-protected security with a maturity of 10 years are less than 1%. Mm-hmm. It seems that there are risks of inflation and risks of higher interest rates that one is not really compensated for today.
Now, the Chinese, for instance, hold a lot of Treasury securities,
yes.
U.S. Treasury securities. And even though they're diversifying supposedly into some sovereign debt of European countries and whatever, but good luck to them in that area. So you know, I mean, what's the alternative if as far as kind of the traditional use of treasuries has been in portfolios has been for liquidity reasons and also a defensive kind of a non-correlated asset. What do you substitute for the traditional role that treasuries have played in most of our portfolios?
I don't think there is a good substitute.
Mm-hmm.
We simply have to face the fact that the returns on treasuries are likely to be unattractive. And if we want that risk reduction role without risk of loss in a higher interest rate environment, we'll have to have very short maturities or very limited duration. And the yields on those instruments are vanishingly low, which means if you want that safety, then you're going to have to accept a very low return for it, unfortunately.
The dollar, another statement of yours, the dollar is not a reliable store of value. Just explain why the dollar is not, and again, what's the substitute for the dollar, which is, of course, the world's reserve currency still?
I don't think there is a great substitute for the dollar. And every day we ask ourselves, what can we use as a substitute for the dollar? The euro has its issues. The yen is an expensive currency. The pound has its issues. And those are the only really big currencies that there are that are freely traded. Right. Now, at some point, the Chinese yuan is going to be more freely traded, but it's not functional as a reserve currency today. That's one of the reasons that gold has become more popular, is simply many investors are seeking an alternative to the big currencies. They can't find one they like a lot, so they put some money in gold.
But some money in gold. I mean,
yes.
You're really limited because gold is, it's a hard asset, and you can't use it as a paper currency. So that's one thing to have as an investment, but again, a liquid, means of trade and commerce. It's not. So what do you do with the Global Allocation Fund? I mean, what are you using as a substitute for the dollar? What do you use as a substitute for treasuries?
We have a very broadly diversified portfolio.
Right.
And ultimately, we think that's the answer when it comes to a store of value for investors. And with respect to treasuries, what we've done is to keep our duration and maturities very short.
So very short being 3 months, or?
A lot of them are 3 months or less. And then as we go out the maturity spectrum, still we're in 1, 2, 3 year sorts of durations and maturities in a lot of cases. Also, our currency exposure is across a portfolio of over 30 currencies. We're underweight the biggest currencies, the dollar, the euro, and the yen. We're overweight some smaller currencies that have good fundamentals, anything from a basket of Asian currencies, including, for example, the Singapore dollar, to some emerging market currencies such as the Brazilian real, which, despite having appreciated a lot, has good fundamentals in our view.
You were quoted recently saying stocks are the best game in town, but not necessarily a good game, which is not a ringing endorsement of stocks. So why aren't they necessarily a good game?
What we mean by stocks being the best game in town is that relative to other securities, stocks are the most attractive. What we mean about stocks not necessarily being a good game is that while we think there's a strong relative valuation argument for stocks, especially compared to bonds, as I've said, we're pretty negative on the return outlook for bonds. And so that might be the bigger statement there when it comes to relative pricing. Also, while valuations on stocks appear to be very attractive and very undemanding, for example, if you look at the 50 biggest stocks in the S&P 500, there are only 8 of them that trade with a PE ratio of 15 or above, only 8 out of the biggest 50. And 15 is not a demanding PE historically. There are 16 stocks on 2012 consensus earnings estimates. 16 out of those 50 biggest stocks trade with single-digit PE ratios. Those are valuations that get our attention. Having said that, we believe profit margins are already very high and are unlikely to expand cyclically in a normal fashion from here. In other words, the big ramp up in profit margins has probably already happened. So we have to worry a little bit about the outlook for margins and profitability from here, and that may attenuate to some degree the attractiveness of stocks, but they're still the best game in town.
So let's talk about, one of your themes has been that, again, we've been talking about preserving purchasing power and finding real stores of value. So one of the places that you can find real stores of value, of course, are commodities. Are hard assets.
About the only commodity that we can invest in directly is precious metals. It's pretty much directly.
Oh, you can directly. You don't have to do it through an ETF or.
We can effectively do it through an ETF, but the ETFs there are relatively pure plays.
Right.
In terms of other commodities, we'd be in the position of buying a commodity producer, for example. And as I mentioned, energy is an area that we think is very favorably positioned secularly, because in the developing economies, in particular China and India, per capita energy use is still very low, but it is growing rapidly. And as those economies develop, that per capita energy use is going to go much higher than it is today. And at the same time, in order to replace or add an incremental barrel of new oil reserves is very expensive today. So owners of existing reserves are in a very good position, and companies that help other companies find and exploit new reserves of oil are in a very good position in our view.
So, speaking of kind of real assets and real stores of value, and another theme of yours has been to invest in what you call real businesses. So
Sure.
Tell us what real businesses are. What do you mean by a real business?
That's the typical company. And I say a real business to differentiate from a financial business. A financial business is generally one in which the company is borrowing money at one rate and lending it at a higher rate and earning a spread and paying expenses beyond that. But while that is a real activity, it is not the same thing in general as inventing something new, producing something, distributing something. It's a different kind of business. And we think the businesses that are involved in invention, production, distribution, and so forth are more real in terms of stores of value than our financial businesses.
And so, for instance, what kinds of companies are you talking about when you're talking about real businesses?
A wide variety of companies, anything from a technology company to a healthcare company to an energy producer.
So IBM, Johnson & Johnson, ExxonMobil, whatever.
Union Pacific, you name it,
Yep.
a wide variety of them.
Now, it's so interesting that here you are in a financial services business. You're saying that financial companies aren't real businesses. I mean, what about are asset managers real businesses? I mean, this is where you work.
They're very much real businesses.
Okay.
They exist.
Distinction.
But their value tends to be a function of the level of financial markets and the value of paper assets to a much greater degree than, say, the value of the Union Pacific Railroad. Doesn't depend so much on the level of the stock market. I would hasten to add that there are going to be times that the financial sector is very attractive, and we think one of those times may be ahead, but we still have to work through a lot of assets that are housing related that are not necessarily fully marked down, and the losses are not necessarily fully realized. There's still a big problem in the existing housing stock, and there are surplus houses on the market. There's still pressure on their prices, and we haven't worked all the way through that yet. Someday, we'll be more bullish on the financial sector.
Okay. So, looking ahead, Dennis, and the way that you're, operating the Global Allocation Fund, again, do you see any other, trend that you're going to end up following? Are you doing things differently now than you would have done, let's say, 3 or 4 years ago?
We're a little bit more cautious on the developing markets than we were, say, 4 or 5 years ago, where we had at that time a combination of superior growth and valuations where you didn't really have to pay for that growth. And we actually think that we may be getting to that point again. But in the meantime, there was a run-up in the level of a number of those markets, and they became a bit more expensive than they'd been, so you had to pay for the growth. There have been some sell-offs in some of the markets, and at the same time earnings have come up, so valuations have gotten a little bit better. When we get to the point where we have less concern about inflation and less concern about tighter monetary policies, there may be some good entry points again in a number of the developing markets.
Final question is the one investment for a long-term diversified portfolio, what all of us should own something of, and obviously you cannot recommend your own fund, but you have a great track record in, I've looked at the past 10 recommendations that you've made, and just about, well, maybe with 1 or 2 exceptions, they've all made money for our viewers, so we are appreciative of that. So what do you have for us today?
As I mentioned, big cap high quality stocks we think are very attractive, and a particular big cap high quality stock that's not getting a lot of respect right now, but which we think is very well positioned and could present a good return versus risk opportunity for the viewers, is simply Microsoft. Microsoft trades at less than 10 times 2012 consensus estimates. It has a significant cash position between $4 and $5 a share in net cash. If you took that cash out of the price, Microsoft trades at under 8 times earnings, and it has a new product cycle coming with Windows 8. So we think Microsoft is strongly positioned, has a catalyst for earnings growth, has a great balance sheet, and is very modestly valued. That seems like a good risk-reward trade-off to us.
All right, well, the Gates Foundation thanks you for that recommendation at any rate. Dennis Stattman, it is such a pleasure always to have you in WealthTrack, so thank you very much for joining us.
It's a pleasure. Thanks for having me.
Next week, we will be hearing the views of financial thought leader, best-selling author, historian, teacher, and commentator Neil Ferguson on America's economic, educational, and debt challenges and how we might overcome them. To see this program again, please go to our website, wealthtrack.com, to watch it as a podcast or streaming video. And while you're there, check out WealthTrack Extra, where you can find complete extended interviews with other recent great investor and financial thought leader guests. Thank you for taking the time to visit with us. Make the week ahead a profitable and a productive one.
Additional funding provided by Loomis Sales, investors seeking exceptional opportunities globally, research affiliates, an efficient index for an inefficient market, Wintergreen, your home for global value, and Rosalind P. Walter.